I think this is the first sort of major pullback since that low back in March. We think people should not be in a rush to commit new capital right now. I think, especially in front of the election, let things play out over the next couple of months and look for a re-entry point a little bit later in the fall. I think, retail and technology, which have been the leaders of this market, are pulling back right now. We think it's unlikely that the tech correction is over yet. So we think some of these big names that have had big moves are probably going to pull back a little bit and may give investors a much better buying opportunity either right before or right after the election.
For more on this, National Securities Chief Market Strategist Art Hogan joins me from Boston. Good to have you on the program with us. First off, what's behind this correction that we're seeing? Is this just investors coming to their senses after overinflation of the sector?
Yeah, it's interesting. So we've had a market that's gone unidirectionally higher since the lows of March 23rd. We've had one small 7% drawdown in June, but other than that, the market's clearly gotten ahead of itself a bit, and especially in the first couple of weeks of August. We actually saw the relative strength index, the RSI for the Nasdaq composite, the Nasdaq 100 and the S&P 500, get dangerously overbought. The RSI typically sits around 50. When you get above 70, it's indicating that either an index or an equity is overbought, and it got close to 90 on all three of those major market indices. So we were due for a pullback. The Nasdaq 100 was sitting 30% above its 200-day moving average. Again, that's a record. Too far. Investors needed a reason to take a pause. We walked into September, which is a difficult month for markets, and once that momentum shifted, very much like on the upside, momentum goes very quickly on the way down, and we took about 10 or 11% out of the Nasdaq in 3 trading days, and I think that gets us to a healthier place. Those RSIs are down in the 40s, in the low 40s now, so clearly taking a lot of the froth off the top of a very toppy market.
Right. So why were we seeing such overinflation in the tech sector to begin with? Because economies are contracting right now. Amazon, for example, was trading at something like 120 times earnings.
Yeah, well, so there's a group of companies that have proven they are very necessary in the world we live in right now. So it's a pandemic, it's an economic slowdown, it's work from home. And those types of companies that have helped us navigate that process have certainly done well. Amazon's never going to look on paper with a PE multiple like a very attractive company. That's been true for the entirety of its public relevance. But when you think about all the things Amazon's doing, Amazon Prime, Amazon Web Services, it's just a company that's grown into this giant, very necessary part of all of our lives. And I think that's true of a lot of the companies that have actually fared well. What I get more concerned about is that sponsorship of these Fab 5 companies that have really driven a lot of the gains in the S&P and the Nasdaq. When we start to navigate into a place that's more normal and start investing in some of the economically sensitive cyclicals, I think the kind of drawdowns that we saw are going to be typical of what we see as we head into a new year. We're beyond a vaccine. People are actually feeling safer doing the things they couldn't do before, and the economically sensitive stocks actually start taking off. That rotation may well be at the loss of some of the high-flying momentum mega cap names.
Mm-hmm. Now, despite this route, we didn't see any spillover into other corners of the market. What does that indicate to you? Is that a positive sign that this actually could have been a lot worse than it was?
Yeah, I think so. You've got a Dow Jones Industrial Average that's off about 7% since the beginning of the sell-off. The S&P down about 7%. Remember, that's very normal. In any given year, we expect to see 3, 5, 7% drawdowns. The Nasdaq obviously up much higher on a year-to-date basis, pulled back more, but I think that's normal. The fixed income market is held in very strong. There's no crisis in the debt markets. The only other commodity-driven market that really saw a lot of pressure, unrelated to the equity sell-off, was the energy market. But I think that has a whole lot more to do with Saudi Arabia cutting some prices over the weekend.
All right, we'll leave it there. Art Hogan in Boston. Thank you so much for your time.